vacation homes. So what happens if we have a property that we are using partially personally and partially renting out? Okay, usually we consider those to be vacation homes. How we treat it for tax purposes depends. Okay, there are three factors that we have to look at. Well, not three factors, there are three different categories of use. So we have primarily rental use, and we have to define what that means. Primarily personal use, and then we have personal/rental use. All right, so what we have to do is compare the number of rental use days by the number of personal use days. So I'm going to pull that screen up here in just a second. Show you. All right. So we compare the number of rental use days by the number of personal use days. Depending upon what that result is, will determine then whether it is primarily rental, primarily personal, or personal/rental. All right. This first one is the hardest, so I'm going to leave it for last. Second one's the easiest. If it is rented for less than 15 days, it is categorized as primarily personal. Okay, so less than 15 days during the year. 14 days is less than 15 days. 15 days is not less than 15 days. Okay, so less than 15 days, it is primarily personal. If it is rented for 15 days or more, so exactly 15 days or more. So the first thing that I would do is say, okay, does it meet this category? If it does, cool, it's primarily personal. Then we'll look at what the rules are for primarily personal property rentals. If it doesn't, then we got to see if it meets number 1 or number 3. So if it's rented for 15 days or more, and the personal use of the property is more than the greater of, whichever one's largest of these, 14 days, 10% of the total rental days at the fair rental value. So you might want to work this backwards. First compare, okay, so personal use. Did I use it for more than 14 days? Greater of. More than 14 days or 10% of the total rental days at the fair rental value. If I did, then it's going to be categorized as personal/rental property, and we'll get into what happens when that is the case. If it doesn't fit that, if it is not used for more than 14 days for personal use. Okay, so this one actually might be the easiest one to go to second. So first one, ask yourself, is it rented for less than 15 days? Yes, okay, it's personal. No, okay, let's go to the second one. Now we're going to ask about personal days. More than 14 days or 10% of the total rental days is personal use. And it's rented for 15 days or more, which obviously it is, because if it wasn't, we'd be using this one, is categorized as primarily rental. If it doesn't meet that category, then it meets the third category. Let me put up the chart here, because I think this is helpful. And we'll go through a problem. These are on so you can find these, there's a link to whiteboard images. And this is just one that Okay, step 1. How many days did you rent it? Was it less than 15? Stop, it's primarily personal. Okay, so that's the first one. Was it equal to or greater than 15? Then we've got to go on to steps 2, 3, and 4. So if it was greater than 50 or it was exactly 15, calculate 10% of the rental days. So how many days was it rented? Let's take 10% of that. Step 3, choose the larger of, whichever is bigger, 14 days or what the step 2 result was. Step 4, is step 3 smaller than the number of personal use days? If the answer is yes, it is a rental / personal. If it is no, it is primarily rental. So, and I'll go through some examples here. So what does that mean if it's primarily personal? The easiest one here. If it's primarily personal, you do not have to claim the rental income. It's one of those rare instances where the IRS says you don't have to pay tax on income. So you can rent your personal home out for up to 2 weeks, get income on it, and you don't have to pay any tax on it. Now, you also don't get to claim any expenses against it other than, the mortgage expense that you might already be claiming on your Schedule A and the property taxes, but those would be on your Schedule A, not on any Schedule E, but you don't have to claim any income tax on it. Doesn't matter the amount, right? You own Mar-a-Lago and you rent it out for, I know Mar-a-Lago is not a good example because it's not really a personal house, but let's pretend for a minute that it was. Rent it out for 2 weeks for $1 million and use it personally for the rest of the time. You don't have to pay tax on it, on the $1 million. As long as the rest of the time was personal. So what happens if it's rental / personal? Then we do claim the rental income and we claim the rental expenses, but only to the extent of income. So we cannot take a loss on that if it's combined rental personal. If it's primarily rental, we just treat it like a rental. Rental income and then the rental expenses that are associated with the rental portion of it. We can take losses if we are entitled to them, and we report it on the Schedule E. That's why that question asked about fair rental days, like how many days did you rent it, how many days did you use it personally? That's where that calculation would come in, right? Okay, so let's experiment a little bit. Let's say we have a house and it is rented. The rental is 16 days. Rental days are 16. Personal are 200. All right. Step 1. How many days was it rented? Less than 15? No. It was rented 16 days. So we know it is not primarily personal. So we got to go on to step 2. Step 2, calculate 10% of the rental days. 10% of the rental days. Yeah. 1.6. Step 3, choose the larger of 14 or 1.6. 14 is larger of those. Is the step 3 result less than the number of personal use days? Well, 14 is less than 200. The answer is yes, it is rental / personal. Okay, so we have to claim the rental income, but we get rental expenses up to rental income. We can't take a loss. Now we only rented it for 16 days, so chances are we don't have a whole lot of rental expenses that are going to be associated with it. We can take the portion of mortgage interest and property taxes and insurance and all that stuff that applies to 16 days, right? But we're probably gonna have to pay some tax depending upon how much we got out of it. So let's do a different one. Let's say we have, so we rented it for 35 days, and we used it personally for 35 days. It was empty the rest of the time. All right, so number one, yes, it's more than 15, so we've got to go to step 2. 10% of the rental days, so step 2, 3.5. Step 3, the larger of 14, or 3.5, 14, is 14 less than the number of personal use days? Yeah, 14 is less than that. So again, it's rental slash personal. Okay. Let's do another one. Let's see. Let's do it, well, let's say 30. Trying to find a scenario that would get us a different answer. First scenarios, I mean, primarily personal is easy, just anything under 15. Trying to get us something that's gonna get us a primarily rental. Well, no, it's gotta be less than 14. Let's do 300 days rental and 20 days personal. All right, so how many days was it rented? 300, yeah, that's more than 15. 10% of the rental days, 2. 10% of the rental days is 30. Step 3, larger of 14 or 30. 30. Is the step 3 result less than the number of personal use days? No. This is more than the personal use days. It is primarily rental, which kind of makes sense, right? 300 days, 20 days personal. We get the rental income and all the rental expenses, and we can take losses on it. Yeah?
Yeah, I want to pick up my dog to school, so.
Okay, yeah, sure. I'm glad I found that. I have to recreate it. All right, so this is helpful. This step. I don't know about for you, it's helpful for me. That's for sure. So it depends on how many days it's rented and how many days it's used personally. All right, let me go back to primarily rental. So 4 months, 120 days rental, and 13 days personal. Well, obviously it's not primarily personal because that's more than 15. 10% of 120 is 12, so we'll compare 14 to 12, or the number of personal days, more than 12, yes. So then it would be primarily, or it would be personal slash rental. If you use the cabin for less than 15 days, it would be categorized as primarily personal. All right, so personal use of a dwelling. How do we define that? So that's any use by the taxpayer, member of the taxpayer's family, or any other person with an interest in the unit. And not like an ownership interest in the unit. Any individual who uses the unit under an arrangement that enables the taxpayer to use some other dwelling, so you're trading properties. Any individual unless for such day the dwelling unit is rented for its fair rental value. So if a taxpayer lets anyone, family or non-family, use the rental property free of charge, those are considered personal use days by the taxpayer. So that increases your personal use days, decreases the chances that you're gonna be able to deduct more expenses, right? If any family member uses the rental property, the days are considered personal use days. Family is defined here. Any day spent working substantially full-time repairing or maintaining the property does not count as a personal use day. So if you have a lake home, and you're gonna go up there and you're gonna stay, make sure that you do work on it, because then it won't be considered a personal use day. Even if other family members are using the property for recreational purposes on the same day. All right, and we went through all of this, what it means. So primarily rental use means that we're gonna claim all of the expenses and all of the income on Schedule E. We can take losses if we are entitled to them. Primarily personal means we don't have to claim any income that we receive. So they've got an example here, Kirk and his family in Augusta. Each year during the Masters Golf Tournament, they rent their house to a major corporation for $10,000 for the entire week. Because he rents his house for only 7 days, the property is considered primarily personal. He reports none of the rental income or expenses. So there you go, $10,000 free money, right? Personal / rental, again, personal rental, you get to claim, you have to claim all of the income, and you can claim all of the expenses up to 0. You cannot take any losses, right? So you can only offset the income. You can't take any losses. I don't know if this is helpful at all. I'm not gonna go through this. But this kind of gives you another way of looking at that. Let's see. I'm not gonna go through that either. Okay, so that whiteboard image, do you want me to put that like with the videos, maybe? I mean, you can click on it, you can see all of those whiteboard images. It's right at the front of Canvas there. But I can make it a little bit more accessible, put it in with this chapter, if that's helpful. Okay, so that's determining, so that has to do with dividing up the time that it's, and the purpose that it's used for during the year. So we've got different, it's 100% used for one purpose during a particular period of time, right? Now we're gonna talk about what happens when we have one property that's used 100% of the time for multiple purposes, right? Okay. Any questions about this? No? Okay. So allocation, actually, I'm gonna